video, we will go over the trading model, over the trading strategy I'm using for many years. And as I'm showing you on my YouTube channel and with my students in one-on-one sessions, this is the model and edge we are focusing on daily basis to trade the markets, especially the FX. And in this video, we will go over the euro US dollar. So this video will be similar as the one I posted yesterday about the euro US dollar and how you can actually look for trading opportunities either as a swing trader by not spending more than 20 minutes per day trading, or as a intraday trader focusing on trading entries on lower time frames, such as 15-minute time frame, when you combine the hard time frames and the lower time frames. So combining both time frames, of course, the hard time frames and the lower time frames, is very powerful for your own trading, because you focus on trading with the bias, and you wait for that clear direction for the structure in order to make a better trading decisions on the long term. So let's go to the euro US dollar. Of course, today and tomorrow we have a lot of bank holidays, and therefore you have to be of course careful with the new trades. So this video will be the last one for this year, because it's the last day of the year. Later on we have a dinner and everything, so I will close the charts for a few days. So let's start with the euro daily time frame. So before you start trading any pair, you have to understand what is the structure, what is the bias there, and how you get the bias and the structure overall is simply by focusing on highs and the lows of the price. So price action is never it's never lying. That price will be always right, and if you will follow the price, you will be successful on the long term. So just if you focus on the last recent highs and the lows, we can see that market is overall in a bearish structure. As you can see, when the market is creating lower highs and lower lows here, and then of course we have a bearish structure. So what we also noticed here was this last swing high from December. So you can always mark the levels of highs and the lows, because those are the liquidity levels that price will try to reach those levels. And if you just mark the few highs and the lows, then of course it will be good for you to understand the overall structure and bias of the market. So here we had the previous swing lows from the December, and of course also from November, the lows down there, working as a next liquidity level the price is trying to reach. And here we have of course also the major last swing high here. And because the structure is bearish, that means that ideally want to look for potential short trading opportunities. Here we had also kind of a higher low, but of course, because this low was not tapped prior to this one, this level is the most important for now. Because if we have a bearish structure and price is trying to retrace and kick out all those previous highs, then there will be a high chance for the market to move back into this overall direction. And once we got yesterday this huge spike and hard time frames resistance, the buy side liquidity was taken out. This is a really good sign for possible reversal and continuation lower, to combine and to start looking for lower time frame. So if you have a downturn direction and you see like price making kind of a spike at resistance, sorry for my bad voice, I'm still sick a little bit. So if price spikes at this resistance and moves back lower, that means that the buy side liquidity was taken out, and there is a high chance for the market to roll over back to the downside, in this case when we have bearish structure. So in this case we got a spike here, previous highs liquidity was taken out, and then we can start looking for possible structure shift on the lower time frame, such as 4 hourly. So if we get a rollover to the downside, then there is a high chance that price will try to probably reach next support levels here, the previous lows, and of course the lows from November, and market is trying to reach those next lows down there right now. So going to the 4 hourly time frame, this is the daily. Now we move on to the 4 hourly, and when you understand the daily structure, you have to go to the 4 hourly in order to position yourself properly. So what do we see on the 4 hourly? This was the daily top, the daily high. Then we had the Friday's high that were not above this one, and overall we had this bullish structure. So as long as the market is creating higher highs, higher lows, we can still target the next liquidity level, in this case the daily resistance up here. But once the price is reaching those levels, in this case this high, and then that's the time that you want to pay close attention for possible reaction. So if the market is not breaking higher and confirming new highs, then of course the opposite direction is, the opposite scenario is a potential liquidity sweep. So if price took out that higher time frames liquidity sweep, this high in this case, as this spike appeared, then of course you're looking for possible shift to the downside. So in this case what we had was this daily structure highs, and then we had 4 hourly bullish structure. We took this higher time frames liquidity, and then we spiked and moved lower. So if we go from this bullish structure to the bearish and we see breakout to the downside, then ideally we want to see shift to the downside. So we have liquidity sweep, liquidity sweep, then we have structure shift to the downside, we have lower low, retracement, and on the breakout to the downside we had also small fair value gap zone as a confirmation. This is very important, especially as a swing trader or day trader. In this case we will cover both styles, but what I'm trying to say here is, in this case we had bullish structure on the 4 hourly, we took higher time frames liquidity, price spiked and then immediately moved down, broke to the downside, and on the breakout to the upside we had also fair value gap zone. So this is where you have to pay attention in terms of potential new trading ideas and setup. So once you get this breakout of this bullish structure to the downside, and you have like fair value gap zone there after liquidity sweep and fair value gap zone, you want to look for possible opportunities either on the 4 hourly or lower time frames. So I will show you how you can trade as a swing trader. As a swing trader, of course, you have to have this fair value gap zone, which is around 10 pips, not a big one, but still it's there. We have Fibonacci, so you can mark this spike here, or where you have the most touches here in this level, and when the market comes above 50% discount area and fair value gap zone, that's where you want to look for potential opportunities to enter. So in this case your entry will be at those levels, your stop loss goes above the structure, in this case around 50 pips, and you will target, as you can see, the next liquidity levels, at least those lows here, or the major daily lows down there. So in this case you'll be looking for, depends on your entry, if your entry was let's say here or less, in this case you're looking for 1 to 2, 1.5 in terms of risk and reward ratio if you are trading from the 4 hourly time frame. Now if you combine that with the 15-minute time frame, let's jump to the 15-minute time frame in this case. So if we zoom out on the 15-minute time frame, you're looking for shift. So in this case, this is our trading day. In the Asian session, market was bullish, then we turned bearish, And when the London opened, this is very important, we had, as you can see, bullish shift to the upside. And once the London opened, we are looking for shift to the downside. So we have bullish structural shift. Market is above 4-hourly 50% area and also above this fair value gap zone. And when the London opens, you want to see, of course, liquidity sweep, breakout to the downside, fair value gap zone, and then look for possible opportunity to the downside. So in this case, this was our setup, shift of the market structure. We have fair value gap zone, entry here, stop loss above the structure, and you're looking for to target the at least lows of the day, or even more, depends on your style. Maybe yesterday's lows down there, so you're looking for at least 1-to-1 or 1-to-2 and more in terms of risk and reward ratio. So that's how you can trade as a swing trader or as a day trader. And this was a great example how you can combine both, or just focus on the one which suits your trading style best. So that's how you can trade the markets in the upcoming year 2025. Today is of course banks holidays and everything, so of course this is just for good educational purpose. We are not trading today because banks are closed, but that's how you can focus on your trading business in the upcoming year. So thanks for watching, and we catch up soon. Take care.